Let's talk first about co-ops. In addition to all of the regular loan requirements, smaller co-ops, say those with fewer than 10 units, confront some very special challenges. First, in this market segment, there is a very limited group of lenders. So if your co-op has fewer than 5 units, there may be just 2 or perhaps 3 lenders willing to do a loan. So with so few lenders, you're not in a very good negotiating position. The second challenge is cost. Because underlying co-op loans, regardless of size, are commercial mortgages, lenders require the very same documentation of smaller loans that they do for big ones. That means a full commercial appraisal, which is a lot more involved than the simple 1 or 2 page report that many co-op apartment buyers have seen. There's also an engineering report of the building's physical condition and an environmental risk assessment. Then you'll pay your own legal fees, but also the ones of the lender's attorney. There'll be title insurance, survey updates, searches of the public records for violations and liens, and if the co-op is increasing the amount of debt on their building, there will be mortgage recording tax. The third challenge is rate. Prior to 2009, there was a fairly active market in smaller co-op loans. And that was because the secondary market would buy them. Unfortunately, that process ended in the subsequent financial collapse. So today, smaller co-op loans receive interest rates which are between 2 and 4% higher than those on larger loans. Now let's talk about condos. Smaller condominium buildings tend to borrow very small amounts of money, so they typically don't have too much trouble. And condo loans in general tend to be smaller, so they don't encounter many of these challenges. But nonetheless, it does require typically an appraisal and some of the other reports, but the costs tend to be a lot less.